The GDP growth of European Union for the last quarter of 2019 was 0.1%, according to official statistics. Economy of Eurozone, the region that includes 19 of those countries that use euro as their currency, grew by the same amount in that period. This happens to be the European Union's worst performance since the beginning of 2013. The American economy has also slowed down in wake of coronavirus spread and grew at its slowest pace since 2016. This has added to Europe's woes, as USA is their largest trading partner and leaves them with little margin for error. Let's explore what has led to this situation and whether the economy of European Union is going to slip into a recession. The global economy has been facing slow growth since the US financial crisis of 2008 to 2009, which has exposed the unsustainable fiscal policies of various countries in Europe and around the world. Greece, the country which spent heartily for years and failed to undertake fiscal reforms, was one of the first ones to feel the pinch of weaker growth. When growth slows, so do the tax revenues, making high budget deficits unsustainable. The result was that the new Prime Minister of Greece, George Papandreou, in late 2009, was forced to announce that previous governments had failed to reveal the actual size of nations' deficits. When the numbers came out, Greece's debts were so large that they actually exceeded the size of the nation's entire economy, and the country could no longer run away from the problem. Investors responded by demanding higher yields on Greece's bonds, which raised the cost of the country's debt burden, and eventually, bailout packages from the European Union and European Central Bank were needed. The markets also began driving up bond yields in the other heavily indebted countries in the region, anticipating problems similar to what occurred in Greece. But why did the bond yields rise? The theory is simple behind it. If investors see higher risk associated with investing in a country's bond, they will require a higher return to compensate them for that risk. This begins a vicious cycle. The demand for higher yields equates to higher borrowing costs for the country in crisis, which leads to further fiscal strain, prompting investors to demand even higher yields, and so on. The European Union has taken action, but the decision-making has been slow since it requires the consent of all nations in the Union. The primary course of action thus far has been a series of bailouts for Europe's troubled economies. In spring of 2010, the European Union and International Monetary Fund disbursed €110 billion, equivalent of $163 billion, to Greece. Greece required a second bailout in mid-2011, this time worth $157 billion. On March 9, 2012, Greece and its creditors agreed to a debt restructuring that set the stage for another round of bailout funds. Ireland and Portugal also received bailouts, in November 2010 and May 2011, respectively. The Eurozone member states created the European Financial Stability Facility to provide emergency lending to countries in financial difficulty. The European Central Bank also became involved and announced a plan, in August 2011, to purchase government bonds if necessary in order to keep yields from spiraling to a level that countries such as Italy and Spain could no longer afford. In December 2011, The European Central Bank made $639 billion worth of credit available to the region's troubled banks at ultra-low rates, and then followed with a second round in February 2012. The name for this program was the Long-Term Refinancing Operation. Numerous financial institutions had debt coming due in 2012, causing them to hold on to their reserves rather than extend loans. Slower loan growth, in turn, could have weighed on economic growth and made the crisis worse. As a result, the European Central Bank sought to boost the bank's balance sheets to help forestall this potential issue. Although the actions by European policymakers usually helped stabilize the financial markets in the short term, they were widely criticized as merely postponing a true solution to a later date. In addition, a larger issue loomed. While smaller countries, such as Greece, are small enough to be rescued by the European Central Bank, larger countries, such as Italy and Spain, are too big to be saved. The perilous state of the country's fiscal health was, therefore, a key issue for the markets at various points in 2010, 11, and 12. In 2012, the crisis reached a turning point when European Central Bank President Mario Draghi announced that the ECB would do whatever it takes to keep the Eurozone together. Markets around the world immediately rallied on the news, and yields in the troubled European countries fell sharply during the second half of the year. Keep in mind, prices and yields move in opposite directions. While Draghi's statement didn't solve the problem, it made investors more comfortable buying bonds of the region's smaller nations. Lower yields, in turn, bought time for the high-debt countries to address their broader issues. The political implications of the crisis were enormous. In the affected nations, the push toward austerity or cutting expenses to reduce the gap between revenues and outlays led to public protests in Greece and Spain and removal of the party in power in both Italy and Portugal. On the national level, the crisis led to tensions between the fiscally sound countries, such as Germany, and the higher debt countries such as Greece. Germany pushed for Greece and other affected countries to reform the budgets as a condition of providing aid, leading to elevated tensions within the European Union. After a great deal of debate, Greece ultimately agreed to cut spending and raise taxes. However, an important obstacle to addressing the crisis was Germany's unwillingness to agree to a region-wide solution, since it would have to foot a disproportionate percentage of the bill. The tension created the possibility that one or more European countries would eventually abandon the euro, the region's common currency. On one hand, leaving the euro would allow a country to pursue its own independent policy rather than being subject to the common policy for the 17 nations using the currency. But on the other, it would be an event of unprecedented magnitude for the global economy and financial markets. This concern contributed to periodic weakness in the euro relative to other major global currencies during the crisis period. Today, yields on European debt have plunged to very low levels. The high yields of 2010 to 2012 attracted buyers to markets such as Spain and Italy, driving prices up and bringing yields down. While this indicates greater investor comfort with taking the risk of investing in the region's bond markets, the crisis lives on in the form of very slow economic growth and a growing risk that Europe will sink into deflation, that is, negative inflation. The European Central Bank has responded by slashing interest rates, and it appears to be on track to initiate a quantitative easing program similar to that used by the U.S. Federal Reserve in the United States. Now, with the slow growth in fourth quarter of 2019 and growing coronavirus concerns, the fears of recession are back. There were several factors that contributed to the unexpectedly bad figures in 2019. According to economists, widespread strikes in France, political confusions in Italy and slumping world trade led to lower economic activity, and now the coronavirus outbreak hampers Europe's recovery. China is a major customer for German cars and other European products. A slowdown in China would spill over to the Eurozone. Europeans are also cautious on President Trump's threats to put tariffs on cars manufactured there. Brexit has also hurt trade between Britain and rest of Europe. France, where the economy shrank 0.1% in the fourth quarter, could bounce back now that the strikes that paralyzed transportation have largely ended. Unemployment in the Eurozone was at 7.4% in December, which is lowest since the crisis began in 2008. Economists have expressed optimism that the fourth quarter was a low point and the growth will recover in coming time, although coronavirus remains a big unknown factor. The novel coronavirus outbreak has now spread to nearly 100 nations, infecting over 110,000 people and killing 3,800 people worldwide. To know the possible impacts of this pandemic on global economy, watch our video on the topic. Make sure you subscribe to our channel and press the notification button to learn more about economic events and for daily economic news and updates.